Hello Kanna, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to discuss the amendments or changes in the deductions chapter for CA Intermediate Income Tax for May 24 and November 24 examinations. But before beginning the video, as usual, my humble request to you is to please subscribe this channel and also like this video dear, so that it will give me more encouragement to keep posting videos. So first amendment itself is very important amendment, and we are going to have a good discussion on this particular section, that is the changes that have been brought in section 10 clause 10D, which is what? Exemption on the receipts from life insurance policy. I think in your institute study material this section will be there in the income from other sources chapter, but however, since I teach this section along with deductions, I have clubbed this amendment in the deductions section. Okay, but before beginning this exemption, it is important to have a little bit context about the deduction relating to life insurance premium. We had learnt in section 80C that life insurance premium paid will be allowed as deduction under section 80C, correct? So there are certain limits beyond which the deduction will not be allowed. What are those limits? If the policy is taken before 1/4/2012, then actual premium or 20% of the sum assured, whichever is less, will be allowed as deduction. So the maximum limit is how much? 20% of the sum assured. If the policy is issued on or after 1/4/2012 till 31st of March 2013, then the maximum deduction that can be claimed is 10% of sum assured, and in case of a policy issued on or after 1/4/2013, then in case of any normal person, 10% of sum assured is the limit, and in case of a person who is suffering from a disease under section 80 DDB or 80U, then 15% of the sum assured is the higher limit. Beyond the limit, the deduction cannot be claimed. Maximum deduction that can be claimed is the limit. This we had studied. Then we had also studied section 10 clause 10D, where we learned that any sum or bonus which is received from a life insurance policy is completely exempt from tax. However, in certain cases the exemption will not be available. What are those cases? First itself we had learned that whenever the policy amount or the premium amount is beyond the limits that are specified in this section, that is 80C, in such case the policy will not be exempt, it will be completely taxable. This we had studied already. Later on, what happened? The Income Tax Act introduced a concept of ULIP, that is unit linked insurance plan or unit linked insurance policy. Okay, so in case of unit linked insurance policy, this is also not an amendment, this is an earlier provision only that I am taking, where if the premium is exceeding 2,50,000 rupees, or if the aggregate premium was exceeding 2,50,000 rupees in case of more than one ULIP, in such case also such ULIPs will be fully taxable under the Income Tax Act. And now the Income Tax Act, that is section 1010D, has brought in another condition. What is that condition? Let us read. If any policy is issued on or after 1/4/2023, here you can write issued on or after 1/4/2023. Then first let us read the provision, then I will explain. Exemption would also not be available if the amount of premium payable exceeds 5 lakh rupees for any of the previous years during the term of such policy. In a case where premium is payable by a person for more than one life insurance policy other than ULIP, and the aggregate of premium payable on such policies exceed 5 lakh rupees for any of the previous years during the term of any such policies, exemption would be available only in respect of those life insurance policy other than ULIP at the option of the assessee whose aggregate premium payable does not exceed 5 lakh rupees for any of the previous year during their term. So now a limit has been brought by the Income Tax Act in case of a normal life insurance policy also. And what is the limit? The limit of premium is 5 lakh rupees. So let me give you an example. Let's say there is a life insurance policy and the policy is issued on 1st of May of 2023. So is it on or after 1/4/2023? Answer is yes. And let us assume that the sum assured is 1 crore rupees. Fine. And we will also, okay, let us keep the sum assured as 40 lakhs for the time being. 40 lakhs. Okay. And the premium payable every year, rupees 6 lakhs. Sum assured is how much? 40 lakhs. And premium is how much? 6 lakhs. Fine. Okay, we'll keep the sum assured as 1 crore so that you will not get confused with other section. Right? So sum assured is how much? 1 crore rupees. Premium is how much? 6 lakh rupees. Now what is the percentage? The percentage is actually only 6%. You get my point? 6% is the premium. So is it within the limits? Answer is yes. It is within the limits that we discussed earlier. So according to the earlier provisions, this entire 1 crore, if it is received by the assessee, it will be completely exempt from tax, or whatever maturity amount is there will be completely exempt from tax in under section 1010D. This was the earlier provision. But now what has happened? Now this 1 crore rupees has become taxable. Why it has become taxable? Because the premium is more than 5 lakh rupees. You get my point? Hence, the maximum premium, life insurance premium, can only be 5 lakh rupees. If the life insurance premium is more than 5 lakh rupees, in that case also, the entire maturity amount is going to be taxable. You get my point? Similarly, sir, what if there is more than one policy? Let us assume that there is a person, Mr. P. Mr. P is having 3 life insurance policies. Policy 1, Policy 2 and Policy 3. Okay. Let us assume for the time being that all these policy premiums are within the limit which is specified already. Okay. That is the 80C limits. Now we are only going to discuss the 5 lakh concept. The premium for policy 1 is coming to 2 lakh rupees. The premium for policy 2 is coming to 3 lakh rupees. And this premium for policy 3 is coming to 4 lakh rupees. Okay. Let us also assume that sum assured for this 2 lakh policy is 1 crore. Sum assured for this 3 lakh policy is rupees 2 crore, and sum assured for this 4 lakh policy is rupees 10 crores. Okay. So premium is given, sum assured is given. Now see here, Kanna, for any of the policy is the premium exceeding 5 lakh rupees? Answer is no. The premium is within 5 lakh rupee range, and also the premium is within the range that we had discussed in section 80C, that is 10% or 15% as the case may be. In both cases it is within the limit. So in all the cases it is within the limit. However, see here, the total premium is how much? Total premium is 2 plus 3 plus 4, which is 9 lakh rupees. Total premium is how much? 9 lakh rupees. Since the total premium is 9 lakh, which is more than 5 lakh, still the life insurance policy maturity or any amount received from the life insurance policy will be taxable. However, in such case, the assessee is having an advantage. What is the advantage? The assessee can choose which all policy he wants to get exempted, and the amount of premium of such policy should be within 5 lakhs. So for example, I can choose that I will exempt policy 1. If I exempt policy 1, then what will happen? 3 lakhs plus 4 lakhs will be 7 lakhs. So this entire amount will be taxable. Correct? I can also choose that I will get an exemption for both policy 1 as well as policy 2. For policy 1 and policy 2, what is the premium? The premium is 5 lakh rupees. Is 5 lakh within the limit? Answer is yes. So I can choose that policy 1 and policy 2 I will claim an exemption, since both combined the premium is within 5 lakhs, and I will treat policy 3 as taxable policy. You get my point? Now there is one more option. I can choose policy 3 as exempt. Since the premium of policy 3 is within 4 lakh rupees, but if I choose policy 3 as exempt, then policy 1 and policy 2 both will become taxable. Both will become taxable. Listen very carefully, this is very important concept. Both policy 1 and policy 2 will become taxable. Okay. Now, what is the most beneficial for the assessee? Should the assessee choose policy 1 plus policy 2, or should the assessee choose policy 3 as exempt? Answer is, in this case the assessee should choose policy 3 as exempt, because the sum received from life insurance policy is going to be how much? 10 crores. Whereas in case of policy 1 and policy 2, both combined also you are going to get only 3 crores. Okay, so choose this 10 crores as exempt, and on this 3 crores which is possibly going to be received, make it taxable and pay the tax, if at all an amount is received from life insurance company. You get my point? So like this, if the amount of premium aggregate is more than 5 lakhs, then the assessee can choose the premium up to 5 lakh rupees to be exempt. Such policies will be exempt and the remaining policies will become taxable. You get my point? I hope it is crystal clear. Now let us discuss how will it be taxed. First let us also go through the other provisions quickly. These are all old provisions only. This section will not apply to sum received by any person under 80DD and keyman insurance policy. Keyman insurance policy we had discussed already. It is taxable under 3 heads of incomes based on the situation. So it is not covered under 1010D exemption. Then there is ULIP, which we had already discussed before itself. If ULIP, if the policy premium is more than 2,50,000 and aggregate is also more than 2,50,000. The same concept as we discussed right now, it also applies for ULIP, and in case of ULIP, the maximum limit is how much? 2,50,000. Fine. And in all the cases, if at all the amount from life insurance policy is received on death, then it is fully exempt. You get my point? So if amount is received on death, you need not see any condition at all. It is fully exempt. If other than death only, you have to see all these conditions. Fine. Now let us learn the new section that has come under income from other sources chapter, which is relating to this life insurance policy, which is nothing but section 56 to 13. Sum received by way of bonus from life insurance policy other than ULIP and keyman insurance policy, which was not exempt under 1010D. Let us study the provision. So where any sum is received, including the amount allocated by way of bonus at any time during the previous year under life insurance policy other than the sum received under ULIP or keyman insurance policy that is not exempt under 1010D, the sum so received as exceeds the aggregate premium paid during the term of such life insurance policy and not claimed as deduction under the provisions of the Act, computed in the prescribed manner, would be chargeable to tax under the head income from other sources. So basically, whatever policy, okay, which is not a ULIP and not a keyman insurance policy and also not exempt under section 1010D will be taxable under income from other sources under this new section called 56 to 13. Okay. Now how to calculate the tax? First and foremost, you have to see whether the amount is exempt or not. If you have found out that the amount is not exempt, then you have to find out under which section it will be taxable. If it is falling under this section, that is 56 to 13, in such case, how to find out the income? The income is nothing but total amount received from the policy, including bonus, minus premium paid, the premium that you have already paid, on which deduction was not claimed. Premium paid on which deduction was not claimed. Because if you reduce the premium paid on which you had claimed the deduction already, then there is no point in reducing from the total amount because you have already taken benefit of that premium. So only the premium paid on which the deduction was not claimed can be reduced from the total amount. So let me take an example, Karna. There is a life insurance policy. Okay, premium is equal to 10 lakhs, and let's say sum assured is 50 lakhs. Sum assured is how much? 50 lakhs. And also maturity amount is 50 lakhs. For simplicity's sake, we will keep the maturity amount also same. Now this premium of 10 lakhs is nothing but 2 lakhs multiplied by 5 years. For 5 years premium was paid and the total premium was 2 lakh rupees. Okay. Now look here Ganna. Is this 2 lakh amount, okay, in this case this entire policy is exempt. I will change the sum a little bit. Let us keep this as sum assured as 15 lakhs and maturity amount also 15 lakhs. Okay. Now listen here. Is this 2 lakh amount within 10%? Answer is no. It is more than 10%. Hence this policy is taxable. 15 into 10% is how much? 1.5 lakhs. So what should be the maximum premium? The maximum premium should only be 1.5 lakhs. However, the premium is how much? 2 lakh rupees, and that is why what will happen? This entire policy is not exempt under 1010D and it will be taxable. Now how to find out the tax? Let us see. Now in case of this policy, every year will the assessee have claimed deduction under section 80C? Answer is yes. Let us assume that every year the assessee claimed 1.5 lakhs as deduction, because maximum how much it is allowed? 1.5 lakhs only maximum allowed. So 1.5 lakhs into 5 years is equal to 7.5 lakhs. You get my point? So here now let us calculate the income. Income under section 56 to 13. In this case, income is equal to maturity amount minus premium not claimed as deduction. So what is the maturity amount? 15 lakhs. And what is premium not claimed as deduction? Total premium is 10 lakhs, out of which 7.5 lakhs was claimed as deduction. So balance 2.5 lakh rupees is the premium not claimed as deduction. So here 15 lakhs minus 2.5 lakhs, answer is the income will be 12.5 lakhs. So this 12.5 lakhs should be added to income from other sources. You get my point? So I hope now you are clear how to find out the income from other sources, how to calculate the income under section 56 to 10. If you want, you can pause the video and note down this example. Fine. Now you can unpause the video. Now for you, I have made a separate special table by which you will be crystal clear how you should tax any life insurance policy. So first I want you to note down this table. I think 1 page space you have at the end of income from other sources chapter. In this page you can note down. Fine. Please pause the video and note down the table. Copy down this table in the page that is available. Then unpause the video. Done. Next. Please copy this part. Done. Now please copy this part, pause the video and finish copying. Done. Now lastly, please copy this part. Finished? Right. Now let us discuss this table. So what you have to do, if there is any life insurance policy, first you have to check whether the policy is within the limits specified under ATC. Okay, so if the policy is issued before 1/4/2012, it should be within 20%. The premium should be within 20% of sum assured. If it is 1/4/12 to 31/3/13, then 10%. And if it is issued on or after 1/4/2013, then in normal cases 10%, in disease case it is 15%. If the conditions are not satisfied, if the policy premium is more than the limit, then what will happen? Then the life insurance policy is taxable. Correct? It is not exempt under 1010D. If it is a ULIP, then it will be taxable under capital gain chapter, section 112. However, it is not covered in your syllabus, it is covered in CA final syllabus. So need not worry about that. If it is other than ULIP, then it will be taxed under section 56 to 13. We had just discussed this example a few minutes back. Correct? Other than ULIP, it will be taxable under 56 to 10. Now let us assume that the limits condition have been satisfied. Okay. If it is satisfied also, we have to see whether the policy was a ULIP or other than ULIP. In case of ULIP, you have to see whether the policy was issued before 1/2/2021. In such case, it will be exempt under section 1010D. If the policy is issued on or after 1/2/2021, then aggregate premium within 2,50,000 will be exempt, and aggregate premium above 2,50,000 will be taxable. Correct? If the aggregate premium is above 2,50,000, then you can choose certain policies, the total premium of which should be within 2,50,000, that can be claimed as exemption, and remaining policies will be taxable under section 112A. Okay, and this is also a part of CA final syllabus. It was removed from CA inter syllabus, so not a problem for you. Now let us discuss about the other than ULIP. In case of other than ULIP, I'm sorry, here you have to make a small change. If the policy is issued before 1/4/2023, then it will be exempt under section 10D, and if the policy is issued on or after 1/4/2023, then if the aggregate premium is within 5 lakh, it will be exempt under section 1010D. If it is above 5 lakhs, then you have to choose the policies whose aggregate premium is within 5 lakhs. That will be exempt under section 1010D, and remaining policies will be taxable under section 56 to 13 as we discussed above. I think here equal to symbol is there. Let me just check this once. Just a second. Exceed. So here one more small change I would like you to make. If the aggregate premium is greater than 5 lakhs, and here you put equal to symbol. Fine. Less than or equal to 5 lakhs, remaining policies. And above also, I want you to make a small change. Aggregate premium is less than or equal to 2,50,000. In such case, no problem. If it is greater than 2,50,000, then policy is chosen. Here also you can write equal to symbol. Up to 2,50,000 exempt, more than 2,50,000 taxable. So this small change only. Now let me summarize once again, very important. So what you have to do, if you have a life insurance policy, you have to check whether it is within ATC limits. If it is within ATC limits, then only you have to proceed further. If it is not within ATC limits, then directly you know that it is taxable and you have to kandupudicify, or you have to find out the tax. Now, sir, what if it is within ATC limit? Then you have to check whether it is a ULIP or not a ULIP. If it is a ULIP, then 2,50,000 you have to see the limit. If the total premium is within 2,50,000, it will be exempt. More than 2,50,000 will be taxable under section 112A. Now let us talk about other than ULIP policy. If the policy is issued before 1/4/2023, then however it will be exempt. If it is on or after 1/4/2023, then if the aggregate premium is within 5 lakh, it is exempt. If it is above 5 lakh, then up to 5 lakh you can claim as exemption. The remaining policies will be taxable under section 56 to 10. Got my point? 25 minutes discussion we have had on this topic. I hope you are crystal clear with the concept, and with this table, you just go through this table once again, you will be even more crystal clear. Now let us discuss the remaining changes in the deduction chapter. First, let us discuss the change in section 80G, okay, that which is relating to donation. Very small change, easy change, that in this 50% unlimited deduction category, what you have to do, three funds have been removed in the act. Which are they? Nehru family, Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Fund, and Rajiv Gandhi Foundation. So if now donation is made to these funds, no deduction will be available, right? Now let us move to the next deduction, which is section 80 CCH. So when I was discussing salary also, I told you that section 80 CCH, along with that I will also discuss the salary provision, and also there is an exemption provision that also we will discuss together. So three sections we are going to study together right now, which is about Agnipath scheme. Agnipath scheme. Sir, what is this Agnipath scheme? Agnipath scheme is a scheme which is brought out by the central government, where the central government will recruit very young people in the army, okay, and after recruiting them, I think the duration of them being in the army will be, I think, 4 years or something. I am not very sure about that, but the concept is that after recruiting, the central government will give them salary, correct? Along with the salary, the central government will also contribute 30% of the salary to the Agniveer Corpus Fund. And similarly, whatever salary is given to the people, correct, to the employee, 30% of the employee's salary also will be contributed to the Agniveer Corpus Fund. And after the entire period is over, the total amount along with interest is given back to the employee. This is the concept, okay. I am not going very deep into what are the features of the fund, why the government has brought this fund, that and all you can obviously browse in the internet. I am only discussing about the income tax aspect. So very simple. Let me discuss it in simple language. Firstly, I want you to pause the video and note down this table. Wherever you find space, please note down this table and then let me explain. Done? Okay. So Agniveer Corpus Fund, it is just a fund, like for example a provident fund, gratuity fund. Similarly, Agniveer Corpus Fund. In that corpus fund, the employee will contribute, employer will contribute. How much will they contribute? 30% of salary. Okay. Now, employee contribution is allowed as deduction under section 80 CCH subsection 1. So, under chapter 6A deduction, you can claim the employee contribution as deduction, just like PF. Okay. However, this deduction is only allowed in the old tax regime. It is not allowed in the new tax regime or default tax regime under section 115 BAC. It is not allowed. Now let us talk about employer contribution. Employer contribution, first and foremost, you have to add to the salary head of income. This only I was talking about when I was discussing salary chapter. So employer contribution to the Agniveer Corpus Fund will also form part of the salary under section 17. You get my point? After adding to the salary income, the same amount you can claim it as deduction under section 80 CCH subsection 2. Okay, entire amount you can claim as deduction. There is no limit. Fine. And this deduction is allowed even in the new tax regime. So it is allowed in both old tax regime as well as new tax regime. Fine. And now comes to maturity. And the amount of maturity including interest is exempt under section 1012C. Fine. So an exemption also can be claimed under both old tax regime as well as new tax regime. So it is a very simple concept. Now if you just go to this page and you read all the provisions, you will easily be able to understand. It is very simple, nothing complicated about this section. The concept is similar to the provident fund or pension scheme which we have already studied. Similar concept will apply here also to Agniveer Corpus Fund. Okay. So I hope you are clear. Now section 1010AA, that is the section which is relating to special economic zone. It is there in the deduction chapter in your study material, but I have already covered the amendments in the PGBP chapter video, which I think is the second amendment video. So I would recommend you, if you have not seen that video already, you can go to that video and then update yourself about 1010AA. So these are the amendments about deduction chapter Kanna. Remaining amendments let us cover in the next video. So see you in the next video. Till then, take care. Bye bye.